So this new lesson is on credit cards and understanding credit reports and credit scores. In this lesson, we'll review the following: looking at interest, balance due, minimum monthly payment for credit card loans, pros and cons of using credit cards, understanding the difference between credit and debit, knowing what's contained in a credit report, and understanding credit scores as measures of creditworthiness. Before we start, you should try and familiarize yourself with the vocabulary that will be used. So you want to try this Quizlet, and I'll also post that to the comments of the video. All right, so interest is calculated using I equals P or T, where R is the monthly rate, T is 1 month, and the principal P is the average daily balance. The average daily balance is the sum of the unpaid balances for each day in the billing period, divided by the number of days in the billing period, which is typically 30 or 31, depending on the month. And there's a formula for you. Sum of unpaid balances for each day divided by the number of days in the billing period. So let's look at an example. So for the balance due on a credit card, we have a particular Visa that calculates interest using the average daily balance method. The monthly interest rate is 1.3% of the average daily balance. The following transactions occurred during the May 1st to May 31st billing period. So let's have a look. We have 4 charges, as you can see here. We have a previous balance of $13.50. We have 3 charges. We have credit for a payment of $2.50 on the previous balance of $13.50. Then we have the end of the billing period here on the 31st and the payment due date of June 9th. The first question asks us to find the average daily balance for the billing period and then round to the nearest cent. All right, first we want to find the average daily balance for the billing period. We make a table that shows the beginning date of the billing period and each transaction date and the unpaid balance for each date. So we'll start with May 1st. We had already had $13.50 on this credit card. That was our previous balance. On the 8th, we made a payment of $250. So we're going to subtract that from the unpaid balance, leaving us with $1,100. On the 10th, we added a $375 charge, so we add that on to the balance, and we have $1,475. On May 20th, we charge another $57.50, so we add that, giving us $1,532.50. And on the 28th, we charge another $65.30 for a grand total of $1,597.80. We now add 2 more columns to our table. So the first column is going to show the number of days at each unpaid balance. The final column will show each unpaid balance multiplied by the number of days that it is outstanding. So there'll be a product of these 2 columns. So let's start with this first one. For our May 1st to May 8th, that was a 7-day stretch. So we're going to put a 7 up here on the May 1st unpaid balance. Multiplying that 7 by the unpaid balance, we get this $9,450 here. From May 8th to the 10th, we have 2 days, and so on. 10 to the 20th, 10. 20 to the 28th, 8 days. And then we have the 4 days for the unpaid balance, May 28th, 29th, 30th, and 31st, before the beginning of the next billing period, June 1st. That's where this 4 is coming from. That's from here to June 1st. Okay, so we find the product of these 2 columns. We put them here in the last column, unpaid balance times number of days. Now, again, the May has 31 days, hence our 31-day billing period here. This is the sum here, $45,000 of the unpaid balances for each day in the billing period. Okay, so now if you recall, to find the average daily balance, we're going to take this figure and divide it by the 31. And dividing those 2 gives us an average daily balance of $1,453.26. All right, on to Part B. Part B asks us to find the interest to be paid on June 1st, which is the next billing date, and round it to the nearest cent. Remember the interest rate, the monthly interest of 1.3%. Recall that T is 1 month and that P is the average daily balance, which is what we just found. Okay, and so multiplying those 3, we get $18.89 for the interest to be paid on June 1st. Okay. The next part of the question asks us to find the balance due on June 1st. The balance due is going to be the unpaid balance on May 31st plus the interest. So we have the $1,597.80, as you recall. I'll show you where that came from. right there. Remember the total of the unpaid balance plus, any credits and charges, and add it to the interest that we just found in Part B. So that gives us the $16.16 and 69 cents. So that's the balance due on June 1st. All right, the last question asks us, based on the fact that this credit card requires a $10 monthly minimum payment, if the balance due at the end of the billing period is less than $360. Otherwise, the minimum monthly payment is of the balance due at the end of the billing period, a percentage of that, rounded up to the nearest whole dollar. Generally, credit cards will charge between 1% and 3% for the minimum monthly payment. So we're going to figure out what's the minimum monthly payment due on June 9th. So let's start with the fact that the balance due is $16.16 and 69 cents, which is greater than $360. So we won't get off with a minimum payment of $10. We're going to have to find 1/36 of the balance due for this particular card. So dividing our $16.16 and 69 cents by 36 gives us a minimum payment of $45. Now we know that minimum payments might get us in trouble, right? Because the interest will continue to accrue and we're just going to owe more and more on the balance. So this is a great segue into some pros and cons of credit cards. Read those quickly together. All right, so some pros: it's safer than carrying cash, right? It's interest-free in the sense that you have some days that are interest-free, not all the time. It can help build up your credit rating. So if you want to take out bigger loans for, let's say, for a mortgage or for a car loan, it can help you with emergency situations, and you can earn rewards, which you can then spend on other things. Some cons: there are a range of fraud schemes that target credit cards. There's high interest if you don't pay the full balance every month. Credit damage: so if you miss credit card payments and ongoing debts, they can damage your credit rating. It can also lead you to some impulsive behavior, so it's tempting to overspend because you don't see the cash exchange. And fees and charges: so you have to watch out for hidden fees, for hidden charges, annual fees, APR, and if you're trying to do like a cash advance, there's some fees behind that, and that can get really expensive. Versus debit cards. For a credit card, you're paying with borrowed money, whereas a debit card, you're paying with your own money. On a credit card, you can spend all the way up to your credit limit, whereas on a debit card, you can only spend what you have.
Credit cards offer purchase protection, allow you to build good credit scores, provide rewards, and zero liability. Whereas, in the sense of fraudulent charges. Whereas a debit card allows you to avoid debt, since you're spending what you have, tracking your spending easier. Fortunately, they don't carry rewards, but also have limited liability.
All right, so let's look at some credit report facts. So credit reports are records of how you've handled credit accounts in the past. The three major credit bureaus, which are Equifax, Experian, and TransUnion, gather the data and sell it. Credit reports list your accounts and your payments, as well as any problems like late payments, collections, or bankruptcies. One common question that I've seen, and this is from NerdWallet here, is that are credit reports the same as credit scores? And no, they're not the same. A credit report takes your credit history and lists it without interpretation. A credit score, however, applies a formula to the data in your report to create a 3-digit number predicting how likely you are to repay the money as agreed. Two companies dominate credit scoring in the US, FICO and VantageScore. Credit score is only one factor that lenders consider. All right, so let's look at a credit report together. All right. So this is a sample credit report. You can see that there's a personal consumer identification here when we start. One thing that you want to do when you get your credit report is make sure that the information that you see is correct. Okay, so if your personal information is incorrect, make sure that you reach out and tell your bank that you've noticed an error. Then you have a public records information, which is data collected from court records and can be viewed negatively by lenders. So because that includes bankruptcies, for example, other public records for civil judgments and tax liens have recently been removed from credit reports, but they could appear in other types of reports. Bankruptcies can stay on the credit report, by the way, for 7 to 10 years from the date of filing, depending on the type of bankruptcy. Okay, so here we have a listing of adverse accounts, which shows lines of credit that haven't been paid, have missed or late payments, were sent to a collection agency, or were charged off, meaning that the company reported the debt as lost income and may have sold the debt to a collection agency. A history of late payments lowers your credit score, especially if it's more recent. Many lenders won't offer credit until overdue debts have been paid. Here's a tip: negative items can legally be removed from a credit report if it's been more than 7 years from the date that the debt first became overdue. If there are old items listed, contact the credit bureau and ask that these accounts be taken off. Note that even if the debt doesn't show up on a credit report after 7 years, a person may still owe the debt and be taken to court, depending on the state and the type of debt. Even if the debt doesn't appear on a credit report, the consumer reporting agencies keep your older debt on file and can release the information when you apply for the following. For example, a credit of $150,000 or more, such as a mortgage, life insurance with a face value of $150,000 or more, or a job with an annual salary of $75,000 or more. So here in the next section, you see listed satisfactory accounts with certain codes here, depending on whether things were paid or not, or if they were late, or if there's no data available. The satisfactory account section shows credit accounts that are current or have been paid as agreed. The accounts listed are from information reported by lenders. Creditors choose whether to report account information to none, one, two, or all three of the major credit reporting agencies, and how often to report. Having satisfactory accounts that you pay the balance on regularly is good for your credit score. The account type lists the kind of credit account. Installment accounts, like car or student loans, where you borrow a set amount and that make monthly payments. Revolving accounts, which is usually credit cards, and they have a credit limit. So those are two kinds of accounts that you want to be familiar with as well. Okay, the credit utilization ratio is how much of the balance is currently reported as being used in all your revolving accounts combined. So in this sample report, there's only one revolving account right here with a balance of $387. If you divide that by the $1,000 credit limit, you get a 38% CUR, or credit utilization ratio. To raise your credit score, keep your CUR under 25%. Some credit scoring models say to keep this ratio under 5% for a better credit score. In the satisfactory account section, future creditors, insurance companies, landlords, and some employers look for a history of on-time payments as a sign that a person is responsible and trustworthy. Positive information is usually listed for 10 years after an account is closed or paid off. If there's a history of late payments, creditors and insurers may still work with a person, but will charge higher rates. All right. And all right, so let's finish off our credit report analysis. This is a credit inquiries section, which includes information about when a credit report has been requested. And there are two types of inquiries. There are regular inquiries, which are also known as hard inquiries. When you apply for credit or buy insurance, for example, the lender reviews your credit report for a positive history and credit worthiness. These inquiries stay in a report for 2 years and can be seen by all creditors who look up your report. Hard inquiries can drop a credit score by 5 to 20 points for many months. Account review inquiries are also called soft or promotional inquiries. Companies ask for certain parts of your credit information to see if you qualify for their services. These items are only seen by you and do not affect your credit score. And that's it. Let us go back. And that's all for now. So if you have any questions, please reach out and I will help you